Hi all, welcome to FinSights Explainer. This is Naren and today we are doing something different. Look, I know what happens every budget month. Your WhatsApp groups explode with forwards about tax slabs. Your Twitter feed is full of memes about what will get cheaper and what gets expensive. And by end of the budget day, everyone's either celebrating or complaining. But here's the thing, and I'm saying this as someone who has been tracking markets and personal finance for years. The real budget story, it's not those on the headlines. The real story is in the numbers that nobody talks about at dinner parties. Numbers like fiscal deficit, capital expenditure, debt to GDP ratio. I know, I know these sounds boring, but trust me, these are the numbers that will decide whether your home loan EMI will go up or down in the next year, whether the stock market will have a good run, whether your company will get new projects and hire more people, or the inflation will eat your salary hike. So today we are taking this time to decode the budget like adults. No panic, no hype, just clear explanations of what these terms mean and how they touch your life. Let's dive in. What's growing? Alright, first up, nominal GDP growth. The budget estimates India's nominal GDP growth will grow at 8.2% for the financial year 2026, that's ending this March, and then accelerate to 10.1% in the next financial year 2027. But what does this actually mean? Think of GDP as the total value of everything India produces and sells in a year. Every car, every dosa, every software code, and every consultation. Nominal GDP is that number without adjusting for the inflation. So, if nominal GDP grows at 10%, it could mean real GDP or real production increased by 6 to 7%, plus inflation added another 3 to 4%. Why does this matter to you? For jobs, when GDP grows, companies earn more, they expand, they hire. Simple as that. For your salary, companies will give better hikes when the economy is growing. For markets, stock prices ultimately follow earnings and earnings follow GDP growth. Now, notice something. Financial year 2026 growth is estimated at just 8.2%. That's lower than what we have seen in the recent years. This signals the government is being cautious, acknowledging that global conditions are tough and domestic demand is a bit soft. But for the financial year 27, it bounces back to 10.1%. That's the government betting on a recovery. What should you do with this information? If you are a long-term investor doing SIPs, don't panic, but one slower year. But also, don't expect fireworks in corporate earnings immediately. Stay invested, stay patient. Now let's talk about where the government gets its money. That's it, taxes. Gross tax revenue is expected to grow 5.3% in the financial year 2026 and 9.3% in the financial year 2027. But here it's where it gets interesting. Look at the breakup. Corporate tax increase by 9.4% this year and 11.1% next year. And income tax is estimated to grow at 10.7% this year and 13% next year. First, the corporate tax number. 9 to 11 percentage growth means companies are making some profits but not booming. In year 2021-2022, we saw around 20 to 25% growth in corporate tax because profits were exploding post COVID. Now it's normalizing. What this tells you about markets? Earnings growth is moderate, not spectacular, so don't expect Nifty to double in a year. Expect steady, slow growth. Now, income tax growing at 10 to 13%. You might ask me, they didn't change the tax slabs. How is income tax growing so fast? Great question. Three reasons for this. More people are entering formal jobs. Every year, lakhs of youngsters get their first salary job. They start paying tax. Salary hikes. Even a nominal 7 to 8% average hike across crores of salaried people adds up to thousands of crores in tax. And the third major aspect is the better compliance. Less cash economy, more digital payments means more trackable income. And why all this matters for you? Income tax growing faster than corporate tax means the middle class is shouldering more of the burden. That's just reality. So if you are salaried, this is why tax saving instruments remain important. Also, if you are young and just started earning, congratulations. You are part of India's growth story. But also, plan your taxes smartly from day one. Coming to the capital expenditure part, or how the government spends its money. The Capex is growing 7.6% in financial year 2026. That's what the government estimates. And also 10% in the financial year 2027. These are just estimate numbers. What is Capex? Simple. It's money spent on building stuff that lasts. Roads, bridges, airports, metro lines, defense equipment and digital infrastructure. These are the capital expenditures the government spends their revenue or the money that are got from us through taxes. This is different from just giving freebies or subsidies. A subsidy gets consumed. A highway stays for 20 years. Think of it like your household budget. Buying groceries every month is necessary, but that money is gone. Buying a house or renovating your home, that's an asset. That's your capital expenditure. Similarly, if you compare groceries to the PDS distribution grains by the government for the 80 million people in India is gone. There is no recovery of that money. But the same thing, at the metro you cross every day, the roads you travel when you are going for vacations, or the railway projects or electrification across India. These are capital expenditure the country spends in. Why is capex so important? Three reasons. It creates jobs. A highway project needs workers, engineers, cement supplies, steel manufacturers, multiplier effect. It boosts productivity. Better roads means goods move faster, lower logistic cost. Businesses become more efficient. That eventually means cheaper products for you. Third, it attracts investment. Foreign and domestic companies invest where infrastructure is good. No one wants to set up a factory where there is no reliable power or roads. Now, this 7.6% growth this year is lower than the 15 to 16% we saw in the previous years. Why? The government is being fiscally prudent. They don't want to overspend and blow up the deficit. But 10% growth next year shows they are not abandoning infra spending, just pacing it better. What does this mean for your portfolio? Sectors like cement, steel, capital goods, engineering, construction, these benefit directly from capital expenditure. If you have mutual funds or stocks in these kind of themes, this steady 10% growth is good news. Not explosive, but reliable. And if you are a small business or freelancer in the new cities popping up, roads, internet, better connectivity means more opportunities for you to grow. And coming to the big one, fiscal deficit. Always we see the headlines in the newspaper the next day of budget. The fiscal deficit estimated to be financial year 2026 is 4.4%, and for the financial year 2027 it's going to be 4.3% of the GDP. But what this number really mean to you? What is fiscal deficit? Why I have to worry about it? Let's see about it. The fiscal deficit is the gap between the government earns and what it spends. If India earns 30 lakhs crore and spends 34 lakh crore, the deficit is 4 lakh crore. Think of it like our own budget. We earn around a lakh per month and we spend 1.1 lakh. The 10,000 the shortfall, that's our deficit. You either borrow it or we will put it on a credit card. Government does the same. It borrows by issuing bonds. Why does this number matter so much? Because it directly impacts interest rates. When the government borrows heavily, it competes with everyone else. Companies, banks, me and you are for the same pool of money. More demand for money, higher interest rates. Higher interest rates means our home loan EMI goes up, our car loan goes expensive, and companies borrow less, invest less, and hire less. Stock market don't like this scenario because fixed deposits start looking attractive. On the flip side, When the fiscal deficit comes down, like from 4.4% to 4.3%, it signals discipline. Less government borrowing equal to more money available for private sector, which is in turn lower interest rates. And here's the kicker. India is targeting to bring this below 4.5% consistently. That's a big psychological mark. Rating agencies like Moody's and S&P watch this number. If we maintain discipline, we could see a credit rating upgrade that brings in foreign investment, strengthens our rupee, and makes imports cheaper. What should we do? If you have floating rates loans, home loan, car loan, this is a good news. Interest rates are more likely to stay stable or inch down over next 1 to 2 years rather than spike. If you are investing, this is a positive for equity markets in the medium term. Slab rates equal to stable valuations. And if you are in your 50s and prefer fixed income, don't expect FD rates to shoot up. They are likely to stay the same range as today. And these are just estimate numbers. Look for these numbers when the budget is announced. The long-term health scorecard. This number makes the fundamental strong for a country. Debt to GDP ratio. For financial year 2026, it is estimated to be 56, and for financial year 2027, it is estimated to be 55. What is this number and how it is derived? It's nothing but the total debt the government owes as a percentage of GDP. If India's GDP is 100 and total government debt is 56 and the ratio is 56. Think of it like this. We earn 10 lakh a year and we have loans totaling outstanding of 5.6 lakhs. Then our personal debt to income ratio is 56%. It is similar to the country. Is that number good or bad? The context matters. Countries like Japan have debt to GDP about 250. USA is around 120. India at 56 is quite actually reasonable for an emerging economy. But here's what's encouraging. It's coming down. Or it is expected to come down. That means India is growing its GDP faster than it's adding debt. That's healthy. Why does this matter to us? A falling debt to GDP ratio signals India can afford to invest in infrastructure. We won't face a debt crisis and rupee remains stable. Foreign investors stay confident on our country. For you as an investor, this is a big green flag for long-term stability. If you are investing in Indian equities, index funds or real estate for the next 20 to 15 years, this number says India's fundamentals are very solid. So what do you actually do with all these numbers? Alright, let's land the plane. You have understood the terms. Now what? Here are few clear takeaways. First, don't expect explosive growth. Expect steady growth. 8 to 10% nominal GDP or 9 to 11% corporate earnings growth. This is a normal year, not a boom year. Adjust your return expectation. If your equity mutual funds give you 12 to 15% returns, that's good. Don't chase a massive 30% returns in the next year. Interest rates are likely to stable to softening. Fiscal deficit coming down, inflation moderating, RBI has room to cut rates in the coming financial quarters. If you are planning to take a home loan, this is a good decent time. If you have a floating rate loan, you might see a relief in your EMIs. Keep doing your SIPs, no drama. This budget is not a game changer. It's a prudent, stable and boring, which is exactly what long-term investors need. Don't stop SIPs, don't panic, don't go all in. Stay disciplined, stay invested and keep your SIPs going. And the last thing, tax saving still matters. Income tax collection is growing at 13%. That means more scrutiny, better tracking, more complaints. Use your ATC, ATD, NPS wisely. Don't leave money on the table. So that's the budget you should be paying attention to. Not the headlines, not the memes, but the structural numbers that shape the economy you are investing in. Remember, investing is not about reacting to every budget. It's about understanding the long-term direction and staying the course. India is growing slowly, steadily and sustainably. The fiscal discipline is improving. Infrastructure is being built. Tax base is widening. Is everything perfect? No. Are there risks? Always. Global slowdown, geopolitics, oil prices, those will create volatility. But if you zoom out, the trajectory is clear. So don't let budget day hype or panic change your long-term plan. Understand the numbers, stay rational, stay invested. We will be having more budget related updates coming in this week. So that's it for today's FinSights Explainer. If this made sense, share it with one friend who needs to hear this. And if you have questions, drop them in DM. I read every single one. Until next time, stay informed, stay invested, and stay smart. Take care.